It finally happened. While Western markets were closed for the holidays, physical silver in Shanghai traded through $82 an ounce. Real metal, real delivery, real bids. Meanwhile, the Western screen stayed frozen in the mid-70s, like nothing changed. That $7 gap is the warning, and Monday morning is the trap. I'm your host, and this channel is where we separate the paper story from the physical story, fast, clear, and with zero fluff. Quick disclaimer, this is not financial advice. This is market commentary and education. You're responsible for your own decisions. Now breathe, because the people who lose money in metals don't lose because they're dumb. They lose because they're late. They wake up after the move, they chase the candle, and they buy into the exact moment the system designed to punish emotional reactions. The silver market just gave you a rare gift, a clean disconnect between what silver costs where delivery matters and what silver costs on the paper scoreboard. Here's what happened in plain English. For a stretch of holiday trading, the West went quiet. New York thinned out. London slowed down. Liquidity dropped. The usual paper pressure relaxed. But Asia was still awake and the Shanghai physical market kept functioning. In that window, the physical price printed above 82. Not a futures quote. Not a swap. Not a synthetic. A price paid for metal that can be delivered. That print matters because it answers a question the paper market tries to delay. What happens to silver when the casino closes and only the vault matters? It goes where supply and urgency say it should go. And supply plus urgency is exactly what the West has been trying to blur with volatility. Here's the uncomfortable truth. Most people think price discovery happens everywhere equally. It doesn't. In silver, the loudest microphone is usually the futures complex. That microphone can shout. It can whisper. It can create noise. It can create fear. It can create a drop on your screen without moving a single bar from a vault. But when a major physical venue prints a huge premium while the West is off, the mask slips. You see two different worlds pricing the same metal. One world is pricing a promise. The other world is pricing possession. And on Monday, those two worlds collide. This is why the gap matters. $7 is not normal friction. It's not just shipping. It's not just taxes. It's not just import paperwork. A gap that wide is the market screaming that near-term metal is scarce, that delivery is valuable, and that paper is lagging reality. Gaps like this do not close politely. They close violently. Either the Western price jumps up to chase the physical truth, or the paper market launches a counterattack to drag the physical premium back down. In both outcomes, someone gets crushed. If the gap closes up, the shorts bleed. If the gap closes down, the chasers bleed. That's the Monday morning trap. You won't know which side gets sacrificed until the machine starts moving, and by then, the first hour has already priced your mistake. Let's talk mechanics, because this is not magic. When Shanghai trades at 82 and New York is still showing 75, arbitrage desks don't see news. They see a spread. They see a potential loop. Buy where it's cheap, sell where it's expensive, hedge the exposure, and capture the difference. That activity forces the paper market to react. Why? Because a large portion of Western price is formed through futures and related derivatives. So when money chases the spread, it often expresses itself as futures buying, spot buying, or a complex package that pressures the Western quote higher. But the paper market has a weapon, volume that isn't constrained by metal in the same moment. It can flood the tape with contracts, widen volatility, and try to convince participants that the physical print was a one-off spike. So Monday becomes a battle between two forces. Force 1, arbitrage and physical urgency trying to pull price up. Force 2, paper supply trying to smash price down and restore the narrative. You need to understand the narrative because the narrative is the tool. The simplest story they sell is, it's over, the rally popped, go back to sleep. Why? Because a sleeping crowd is a manageable crowd. A crowd that realizes physical and paper are separating becomes dangerous. It starts asking for delivery. It stops trusting screens. It stops playing the casino game. And the paper market can survive doubt for a while, but it cannot survive mass delivery demands. That's why you will see language like premium used like a blanket to smother a fire. They will say, China always trades higher. Yes, it often does, but there is higher, and then there's panic higher. $1, $2, that's normal. $7, that is a stress signal. $7 is what happens when the metal is needed now and the market doesn't trust future promises. That brings us to the most important concept most people ignore, backwardation. In a healthy commodity market, future delivery costs more than immediate delivery. Storage, insurance, financing, time, that's normal contango. Backwardation flips it. Immediate delivery becomes more expensive than future delivery. That's not a meme, that's not bullish sentiment. That is the market saying, I need it now, and I don't fully trust the paper promise later. Backwardation is the smell of smoke in the wiring, and when backwardation intensifies, you get regional dislocations like this. Now, here's the part that should keep you sharp. Volatility next week will not be random. Volatility is not a weather event. It's a strategy. When the system feels pressure, it weaponizes motion sickness. Up 3, down 3, gap up, slam down. Green morning, red afternoon. The goal is to force you into reactive behavior, because reactive behavior is how markets harvest money. If you're staring at the chart every 5 minutes, you're letting them rent space in your head. And if they control your emotions, they control your timing. So I'm going to give you a simple mental framework. Ask yourself, does a paper smash change the fact that Shanghai printed 82 while the West was closed? No. Does a red candle refill warehouses? No. Does a scary headline create new supply? No. The supply chain doesn't care about your screen's mood. That's why physical matters. That's why the gap matters. And that's why Monday matters. Now let's walk through the 2 Monday scripts in detail, because you need to be able to recognize them in real time. Script 1, upward reconciliation. The West opens, sees the premium, and the first wave of buying hits fast. Not because retail is genius, because models are automatic, because arbitrage is mechanical, because risk systems respond to spreads like reflexes. Price jumps, stops trigger, shorts scramble, market makers widen. Liquidity thins again even though everyone is back. Then margin kicks in. Margin calls are the hidden gasoline of parabolic moves. When you're short in a leveraged market, a few dollars against you is not a few dollars. It is a forced action, a forced buy, a forced cover. And forced buys don't wait for better prices. They pay whatever is available. That's how markets go vertical. If this script plays out, you can see 82 in the West quickly. And if it breaks cleanly, you can see the next round of psychological numbers appear. 85, 90. Not because everyone suddenly loves silver, but because the system is unwinding positions that assumed the paper market could stay in charge. Script 2, downward defense. The West opens, and the tape gets flooded with sell orders. Big offers, aggressive dumps. A deliberate attempt to slam the quote before the crowd can digest the Shanghai print. The goal is to break momentum and rewrite the story. See? Fake spike, back to normal. If this defense works short term, you will see a fast drop that scares late longs, triggers stops, and tempts people into panic decisions. But here's the cost of that defense. It does not create metal. If physical demand is real, slamming paper simply widens the real-world premium, pulls more metal into the highest bid region, and tightens the spring. So even if the paper market wins a morning, it may lose the week. That's why you must separate trading noise from structural pressure. Now, I want to ask you something, and I want you to answer it in the comments before Monday hits. Do you think the gap closes up to Shanghai, or do you think paper slams it down to defend the narrative? And second question, if you had to choose, would you rather hold a leveraged promise during a margin storm, or a piece of metal that does not care about rule changes? Drop your answer below. I read them, and your perspective helps shape the follow-up coverage. And one quick CTA, subscribe now. One click, because Monday's first hour is going to be the loudest message the market sends all week, and you don't want to catch the replay after it's already priced in. Now let's talk about why this feels bigger than a single print. This year has been a reminder that silver is not just a shiny trade. It is an industrial necessity. Solar needs it. Electronics need it. High-end manufacturing needs it. Data infrastructure needs it. And when the world tries to electrify transportation while building more compute capacity than ever, silver demand doesn't ask for permission. It shows up, daily, relentless, at any price that keeps production lines running. That is inelastic demand, and inelastic demand colliding with limited supply is how you get dislocations. You can argue about charts all day, but you cannot argue with procurement. A factory either gets metal or it stops. It cannot tweet about support levels. It cannot wait for a perfect dip. It buys. Meanwhile, supply is not elastic. Mines do not appear because the price is higher. Refineries do not magically expand because you feel bullish. An above-ground inventory is a finite buffer, not an infinite faucet. So the market becomes a race between two clocks. Clock 1, how fast physical inventory drains. Clock 2, how long paper can manage psychology with volatility. When paper manages psychology, it buys time. When physical drains faster than paper can manage psychology, paper loses control. And when control breaks, it doesn't break politely. Now, let's address the most common mistake I see. People say, I'll wait for certainty. I'll see what Monday does, then I'll act. That sounds rational. It isn't. Because markets charge you for certainty. If it gaps up and holds, your certainty arrives at a higher price. If it smashes down and bounces, your certainty arrives as you chase. If it smashes down and keeps falling, your certainty arrives as you freeze. That's the trap. The market forces you into reaction by delaying clarity until after the best decisions were available. So instead of chasing certainty, decide your lane. Lane 1, position, not trade. If you hold physical, your goal is independence from paper rules. Paper can change margins. paper can halt. Paper can force settlement. Paper can rewrite terms in stress. Physical sits there indifferent. Lane 2, leverage with discipline. If you want leverage, producers can provide it. When silver rises, margins can expand fast for efficient producers. But you must understand hedges. If a company sold future output at lower prices, its upside is capped. It looks like leverage until you read the fine print. Lane 3, patience and timing. If you're not comfortable with volatility, you don't need to play the first hour of Monday. The first hour is where spreads widen and emotions spike. Most people who get hurt do it by trying to do something immediately. And remember, doing nothing is a position too. Now, I want to be very direct about government and exchange tools, because when metals move fast, rules change. If the move becomes disruptive, you can see margin increases. That forces leveraged participants to post more cash or reduce positions. You can see position limits, you can see trading halts, and you can see the nuclear option in extreme stress, cash settlement mechanics that override the dream of delivery for paper holders. You cannot assume the rules stay constant when the system is under pressure. This is not fear. This is how markets preserve themselves. It's also why physical ownership has a different risk profile than leveraged paper exposure. Now, let's paint the Monday picture so you can feel the pressure. You wake up, you check your phone, the chatter is loud, screens show a jump, your brain wants to act fast because speed feels like safety. Then the open hits. If price spikes, you feel FOMO. If price dumps, you feel fear. In both cases, the emotion is the hook. The market wants you hooked. It wants you to chase strength and sell weakness, because that is how money transfers from impatient hands to prepared hands. Prepared hands already know their plan. Impatient hands write their plan in the moment, under stress. That's why the trap works. So what is the simple, cold takeaway? The $82 print was a message. It was the physical market saying, this is the price when delivery matters and the paper megaphone is quiet. Now the paper market has to respond, and the response will determine whether the next phase is a controlled grind or an uncontrolled squeeze. If the West accepts the physical message, you can see a repricing and a new floor. If the West fights it, you will see volatility, smashes, and the same old psychological warfare. But the physical side doesn't disappear just because paper yells louder. If physical demand is real and supply is tight, the story continues. It may not be smooth. It may not be linear. It may be brutal. But the underlying pressure remains. Now I'll leave you with one final thought. And this is the part that separates the spectators from the people who understand the game. Paper is a confidence machine. Physical is a constraint machine. Confidence can be managed for a while. Constraints cannot be negotiated with. You can negotiate with traders. You cannot negotiate with the periodic table. You cannot negotiate with a production line that needs inputs. You cannot negotiate with a warehouse that is empty. So when you see Shanghai print 82 while the West was closed, don't just see a number. See the system revealing its weak point. See the market testing whether paper still controls reality. And ask yourself, before Monday arrives, which world you're choosing to trust, the screen or the supply chain. One more layer makes this holiday print even more explosive. The calendar. End of years when books get squared, risk limits tighten, and liquidity can vanish at the worst moment. Funds don't want ugly positions on the statement. Market makers widen because they don't know who is back at the desk. That's how small imbalances become big moves. There's a second accelerant nobody on TV explains. Options. When price approaches round numbers like 80 and 82, dealer hedging can create a feedback loop. If dealers are short calls, they hedge by buying as price rises. That buying lifts price, which forces more hedging, which lifts price again. It's not emotion. It's gamma. Gamma doesn't care about narratives. This is why Monday can feel like a stairwell with missing steps. 1 minute you're at 76, then a thin print, then 78, then 80, then a wick, then 81.50, then a headline, then chaos. If you try to trade that with adrenaline, you will donate money. So watch the things that reveal truth. Watch speed. Do gaps hold or fade? Watch rebounds. Do smashes get bought instantly or cascade? Watch spreads. If bid-ask blows out, liquidity is thin and moves or exaggerated. And watch premiums. If the screen drops but physical stays bid, the screen is theater. A warning for the smart crowd. The market can trap both sides in the same day. It can gap up, bait longs, smash down, bait shorts, and rip again. The only people who survive that are the ones who already know their horizon. And here's the cliffhanger. If physical is truly pulling away, the next fight won't be about price. It will be about access. Who gets metal and who gets cash? Whether delivery stays a default option or becomes a restricted privilege. When Monday prints, I'll break down what actually happened. Who blinked, where the real bids were, and whether that 82 print was a ceiling, a floor, or the first breadcrumb of a much larger move. And don't get distracted by shiny packaging. In a real squeeze, the buyer that matters doesn't care about artwork, limited editions, or fancy labels. They care about the atom. Weight over hype. Recognizable over exotic. Because when industry is scrambling, it buys melt, not collectibles. That's why premiums can behave strangely. Some pretty products lose relative premium while plain bars stay bid. If you already own physical, your edge is patience. Let the paper game thrash. Your job is to avoid getting shaken out by noise and remember why you bought it. Because Monday is coming fast, and when it comes, the trap snaps.